Good afternoon. I'm Mark Allen with Gaper.io, and I'm here today with Adam Struck, the founder and managing partner of Struck Capital. Good afternoon, Adam. How you doing?
How are you? Nice to be here. Thanks for having me.
Thank you for joining us today. So let's get started right away. Like Struck Capital emphasizes providing founder first capital. Can you elaborate on what that means and how it shapes your investment strategy?
Yeah, 100%. I think generally a lot of seed stage investors don't understand that the precedent that they are setting from a cap table perspective, or just the way that they sort of work with founders. That precedent, positive or negative, is going to sort of be sort of part of the company for as long as it is alive, right? So I think from our perspective, when we think about sort of writing term sheets and sort of negotiating sort of round structure, and then sort of the post-investment value add that comes with that capital. It's really important for us that we preserve cap table optics, that we put ourselves in a position that we have enough of the company to justify all the sweat equity that we put in, but that we also set up the founder and downstream rounds for success. And then again, sort of part of that founder first ethos is obviously deferring to the cadence of our founders, but we like to literally meet with them on a weekly basis and battle in the trenches with them side by side as a partner. We love them to give us marching orders, and then we come back a week later, with a bunch of sort of value add items that we've checked off the box and can bring to the table. So that's sort of the ethos behind founder capital.
So I would safe to say you're more of a real partner. I mean, like right there with the founders, correct? Especially if you're meeting with
100%, yeah.
That's fairly often.
Yeah, I mean, we're only doing around like 20 to 22 deals per fund. We're leading every deal. We're taking board seats. So we really want to treat each investment like a marriage, and a true partnership. What I've just found generally is even at some of the most historic venture funds out there with highly sort of productized sort of platform offerings, I still find that the bar for value add is very low, and at the seed stage, it's even lower. Our definition of adding value is not calling a founder once a quarter and asking what their KPIs are. It's about meeting with them on a weekly basis and trying to really move the needle across everything from product and engineering to talent acquisition to business development to downstream fundraising to media marketing, PR, etc.
And do you strictly do early stage, or do you do any other later rounds?
Yeah, so when we think about sort of portfolio construction theory, it's very important for us to be super disciplined and have that entry point be at the pre-seed or seed stage. So it's all early stage. Now we do save anywhere from 50 to 60% of the fund for follow-on investing. So we are deploying a large majority of our capital for each fund, in sort of that Series A or Series B round. But the entry point is always going to be, that sort of first institutional round of financing. And we love that because we think that's when we can have the most impact on the trajectory of a company.
And it says your firm specializes in seed and pre-seed B2B. So you do not do B2A or B2C?
Yeah, exactly. We love anything with sort of a B2B motion, sort of a clear path to 6-figure, 7-figure ACVs. We care a lot about executing on a unit economic positive sales motion. So sort of what is that, sort of equal, that sort of perfect, sort of mix between sales velocity and then how large the ACV is. What we find just generally is we don't like investing in companies that rely solely on performance marketing from a customer acquisition perspective, which is typically what happens with anything in a B2C motion, because usually you're going to experience unit economic degradation over time. So we love, multi-billion-dollar TAMs, sleepy industries, slow-moving legacy incumbents, and the ability, as I mentioned, right, to sort of execute on a unit economic positive sales motion. And it becomes easier to do that the larger the contract values. So yeah, we definitely have a preference for anything with a B2B motion.
Okay, you somewhat answered my next question, but I'll ask it. What key characteristics do you look for in the startups at these early stages?
Yeah, that's a great question. I think first and foremost, it starts with the founder. We're really looking for founders with robust information asymmetries that can really answer to us not only like why should this company exist, but why are they sort of the right persona to take this company from 0 to 1 and then ultimately through escape velocity. So founders that have unique information asymmetries, have been through adversity, understand that they're going to get punched in the face and want to get back up. Founders that are very well networked. We love founders that come to us that say, hey, with the capital that I'm getting, these are 5 incredible personas from my network that I've already convinced to join me on my mission the minute I've sort of closed that round. So I think first and foremost, it really starts with the founder. What I will say is in this market, our quote unquote seed stage deals are a little bit later than maybe they were at the height of 2021 or even, 5-10 years ago. So typically these companies have anywhere from like 250K to 500K in ARR, which then really allows us to do some more sort of like in the weeds and in-depth financial analysis. So we're going to look at things like net dollar retention. We're going to do cohort analysis. We want to understand if they do have customers, are those customers evangelizing for them? Are they expanding with those customers? So a lot of things like expansion revenue opportunities, churn mitigation. And then, what's nice too is if the product's already gone GA and they've got live customers, we can then go really, really deep in terms of just, how sustainable is the tech? Are they unit testing their code? Do they have the right engineering culture? So honestly, I would say now the sort of like Series A bar, the seed bar is kind of close to where the Series A bar was, like at the height of 2021. So it's nice for us because sort of, more cards have turned over and it allows us to do even more in-depth due diligence.
Interesting that you say that, because what do you think has caused that? Because generally I think of seed as you really don't even have customers yet. You have an idea or a proof of concept, correct? So what has caused that shift, do you think?
Yeah, so I would call that now like more pre-seed. I think at the seed stage, people are definitely expecting material ARR, real customers, and a product that's sort of live and in market. I think just generally right now, sort of interest rates where they are, and just sort of general macro sentiment. What we're noticing is we're advising our companies to have at least between 2 and maybe even 2.5 million in ARR if they're going to go out for a Series A. I remember there were times where 350K in ARR with a really nice month-over-month growth rate. That was even getting you a top market Series A. So I think you're just in a position now that in the later rounds, the goalposts have sort of gone further out, and I think that sort of trickles down. So it's a similar thing now from a seed stage perspective. If founders want to walk in and sort of raise that like $3 million round, at a 12 to 15 post, they need to have a real company with real customers, and ideally even an expansion narrative.
Interesting. So you think HP could get funded today back in, 2 guys in a garage?
I definitely think for extreme talent and the right opportunity and the right tailwinds, if you're doing anything in the Gen AI space, it seems like those rules don't apply.
Yep.
But yeah, I think for somebody that's just got a great idea and ideally a good team, but no real core traction, I would advise them to go the pre-seed route. The nice thing is there are institutionally backed pre-seed funds that literally exist just to fund these companies, essentially prior to the seed round and prior to launching sort of fully fledged products with material ARR. And listen, for Struck as a firm, we can play there as well. Although our typical cadence is to lead that seed round.
Okay. And what do you find most rewarding about working with these early stage founders? And do you have any, particular stories you can share with us that really touched you?
Yeah. We've been very lucky. We've had luck, is what I would say. I think you need to have a bit of it, for those power law dynamics to come into play and for these companies to go all the way. But we were seed investors in Apollo.io that just raised at I believe like a $1.6 billion valuation from Bain and Sequoia. We took the whole pre-seed round of a company called Mythical Games that raised at a $1.25 billion valuation from Andreessen. So we've been lucky enough to sort of start with companies at the inception genesis phases and watch them go all the way and turn into true market leaders. What I would say is, without naming specific names, is when founders go and raise that Series C or Series D from some tier 1 multi-billion-dollar fund, obviously those incredible sort of once in a generation like board members, Midas list VCs, they are able to sit at the board, and even though it's a minority board seat, really have an incredible relationship with the founder and ideally effectuate change in the company for the company's benefit. But typically what we notice, at least with those downstream rounds, is they're really just optimizing for the right terms. They're not necessarily optimizing for partner, and a founder at that stage, whether he or she is has positive habits or negative habits, a lot of it is like already there, right? And it's already in place. What I would say for us, because we're partnering with founders at such an early stage, there really is almost like an emotional element to it as well. And there's nothing that I enjoy more about this business and practicing the art of venture capital the right way is when I can give advice to a founder and they really appreciate sort of my horizontal lens. I tell founders all the time, I'm never going to know more about your business than you will, because you're eating, breathing, sleeping, dreaming, having nightmares about this every day. But for me, I've seen so many different companies across so many different industries go from 0 to 1, and I just fundamentally believe there's a lot of pattern recognition there. So if you just listen to what I have to say, you don't have to take the advice, but if you just listen, it may put you in a place that you're proactive instead of reactive, which in my opinion can make or break a company sort of at the most critical sort of early stage, sort of phase. So I think for me, the reason why I really love sort of early stage investing and why I think it's differentiated from late stage investing is you truly have an ability to just create an incredible relationship with a founder, and that can become a lifelong relationship. It's a very unique situation where we invest in small companies. They need us, they need our platform offering, they need our post-investment value add. But then all of a sudden, they hit major scale and they become market leaders and big deals. And then we're calling on them and saying, hey, can you mentor one of our new founders? Can you add some value here? Can we borrow one of your experts from a diligence perspective? So having that real relationship where they feel like, hey, you bet on me when no one else did, versus, oh, I'm a hotshot company, I got 10 term sheets and I picked one for my Series D. It's just a different experience. And yeah. I really love that emotional aspect, that EQ aspect of early stage venture.
Yeah, it's interesting. It's kind of like, watching a college graduate start their career, and you help them along the way. And one thing I've always wondered, and you probably see this a lot of times the founder doesn't go on to be the CEO when they get into the Series C's, D's, and IPOs. Would you have any idea what the percentage is?
Yeah, it's a great question. I don't have the percentage, offhand. What I would say is I think the average founder goes into it thinking they could be Mark Zuckerberg, right? And they can sort of, create a category and go all the way and lead the company, for years and years and years. The best founders that I've worked with, whether they end up holding the CEO title or not, they fundamentally understand where their strengths are and where their weaknesses are. And, the way they think about it is, I'm going to check my ego at the door. If I own the most equity on the cap table, I have a fiduciary duty to the company and essentially to myself to make sure that the best possible, players are on this team, to allow the company to maximize enterprise value. So, for the best founders that I work with and they can still maintain the CEO title. I don't really mind any of that. I think the key is if you hit that Series A or Series B, can you check your ego at the door and use an incredible sort of executive recruiting firm like a Diversa or True to bring on, that COO or president or CRO or someone that can look at you and say, hey, when you're in that difficult fork in the road moment, I've seen this before because I've taken company X from 50 employees to 500 employees. That to me is a critical component. Weaker founders that are more insecure, they hesitate to bring that type of talent onto the team because they think it's going to sort of usurp, maybe their role or their influence in the company. And for me, that's just like the exact opposite of what it should be. I always tell my founders a little basketball, example is like if you're on the playground and you can all of a sudden draft, pick Michael Jordan to come on your team, like you do that every single time. Yep. So the best founders I've worked with, it's less about holding on to the title. They can still hold on to the CEO title. I think that's fine, but they also understand that they need to bring on personas that have taken companies from Series B to Series D, because I think, as you said, right, it's just a lot of the times people that can get you from C to A or C to B are not the people that can get you from B to IPO. So you have to be willing to adapt, sort of who's on the team based off of where the company is in its maturation cycle.
Yeah, no, I agree. And that is what good friend of mine is founder of a B2B tech company. And he brought in a CEO and he became the COO, and they're doing very well because he said, this is not really my skill set for where we have to go.
Yeah, and I'm sure, if it goes correctly, your friend will be a very wealthy individual because he's got a lot of equity on the cap table, and I think it then works out for everyone.
Yes, he does. I actually will see him tonight. So, and is there a personal story behind why you created Struck Capital, and the reason why you help the young innovative entrepreneurs?
Yeah, you're saying just sort of like what's the genesis story for Struck Capital? Yeah, so my story is really unique, I would say. I was born in Johannesburg, South Africa. I immigrated to the United States at the age of 7. I went to Northwestern University in Chicago. That's why I've got the black and purple here. Did the Kellogg undergraduate certificate program, and then went to Georgetown Law. And then I was actually an M&A private equity attorney at Kirkland & Ellis. I realized really quickly that in terms of my skill set and sort of where I wanted to be in the quote unquote like value chain, I saw myself more as an entrepreneur and a builder. So I actually left shortly thereafter, started a company in the CPG space with my brother called Long Island Brand Beverages. We ended up selling that company to a middle market private equity firm who rolled it up and then took it public on the NASDAQ under our name. And then after that, I had a bunch of friends on Sand Hill Road and had different mentors, that were doing incredible things. And I just said, listen, I know I haven't started a tech company, but I did create something from scratch. I have an exit. I know what 0 to 1 feels like. So maybe I could sort of productize those learnings and really help and advise young founders. And that's sort of how the concept of Struck Capital was born. I started off really just doing SPVs to gain a track record and get people comfortable investing with me, and I got really lucky. I was an early investor in a company called Nutanix that was a leader in what's called hyperconverged infrastructure that ended up doing extremely well. It's a public company today. And then I was also an early investor in Postmates. And then after that, I just, sort of kept building. And today now, it's, we basically have 3 different ways that we partner with founders. We have Struck Capital, Struck Crypto, and Struck Studios. So Struck Capital is our $75 million B2B focused sort of lead seed fund. We then have a crypto fund as well, where we're doing the exact same thing, all early stage investing, but just any founder that's trying to utilize distributed ledger technology. And then we have a venture studio. Our venture studio is actually backed by other tier 1 VCs like Andy Weissman from Union Square Ventures, Rob Chesney from Chicago Ventures, Revolution as a fund invested in us, Liquid 2, US Venture Partners. And with that, we basically are building our own companies. So it's extremely exciting for me, right? Because I'm at a point now in my career where I'm investing and helping companies sort of take things to the next level. But then I'm also putting my money where my mouth is, so to speak, and actually building my own companies. And I think building companies through the venture studio has actually made me a better investor because, when you think about building a company today with the explosion of Gen AI, post-COVID, hybrid workforces, all these things, it's just a lot different than building companies even 5-10 years ago. So while I respect all of my VC colleagues that have built massive companies in the past, in my opinion, the way that you keep your pencil sharp is you build today. And that's what we're doing with the studio, which is a lot of work, but a lot of fun.
And where do you spend most of your, on a typical day? Which one of those ventures do you spend most of your time in? I think I know which one.
It's a great question. I feel like they all level up to the same thing because it's all about 0 to 1 and it's all about early stage. Struck Capital is sort of my baby because that's where it all started. But honestly, again, I believe the work I'm doing on the studio side makes me a stronger investor. And I'm very sort of enticed by just different opportunities in the Web3 space, especially now post the spot ETF approval of Bitcoin and Ethereum. So there's just a lot of opportunities for innovation. For me, again, it's all about 0 to 1 and just creating and being a part of category leading and category changing companies. And I feel like we have the ability to do that across Capital, Crypto, and Studio.
Very cool. So one more question. So you deal with a lot of founders, young entrepreneurs. What is the one piece of advice you find yourself giving to them the most often?
Yeah. I mean, listen, I think the best founders, beyond some things we've already touched on, right? Like checking your ego at the door, leading by example, not just optimizing for terms, but optimizing for the right partner, right, to really take your company to the next level. I think all of those things are table stakes. I would say for me, the top founders do a really, really good job not only communicating with their LPs on a consistent basis, but almost gamifying their action and involvement in terms of really keeping the company top of mind and making sure that they're extracting as much value from the cap table as possible. I've seen a lot of founders, raise these rounds of all these super angels and these big VC funds, et cetera, and they don't even get on like a monthly communication cadence where they're communicating not just to their board, but to all of the investors on their cap table in a very objective manner, not just about what's going right, but most importantly, what's going wrong, what's keeping them up at night, what's scaring them, where are the major risks. The best founders that I've ever worked with, are the ones that are objective. They expect things to be difficult, so they don't mind talking about how difficult it is. And they just do a really, really good job staying top of mind with all of the investors on their cap table, from the lead investor on their board all the way to the smallest angel check, because they realize that the power of the totality of their network is what they can do to sort of optimize or increase velocity in a go-to-market motion or a product build, et cetera. So yeah, my advice to young founders is don't be afraid to communicate really openly, honestly, and objectively to your investors. And make sure with that consistent communication, you're really trying to gamify their involvement so that you can extract as much value from them as possible, which will ultimately benefit the company.
Well, thank you, Adam, for your time today. It's been great talking to you. Maybe I'd love to work with you sometime. Sounds like a great company to work with. I know it's getting late, 4 o'clock in the afternoon here on the West Coast. So have a good rest of your day. I have a feeling it's not over yet. And thank you for joining us again.
Thank you, Mark. It was a real pleasure. And if you're ever in LA, feel free to stop by the office.
I will.